Hello and welcome to the Daily Brief by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I am your host Anurag Bansal. In today's episode, we'll talk about three interesting stories. First, Reliance is trying to enter into a new territory again. This time they're targeting Decathlon. Second, Yes Bank has some new drama that recently unfolded. We'll talk about it. And third, NSE is pushing SEBI to allow them to IPO. We'll talk about what this means for the market and for NSE. So let's begin. Remember yesterday we spoke about Reliance bringing Shein to India to challenge fast fashion brands like Zudio, etc. Now Reliance is aiming to dethrone yet another strong space, sports and athleisure. Because of this, Decathlon might soon face a lot of competition in India. Let me explain. As per reports, Reliance Retail is getting ready to launch its own sports and athleisure or sportswear brand in India. This will directly compete against Decathlon. Now this is huge news and I'm sure you're curious about the details. So let me break it down for you. As per a Times of India article, Reliance is looking for places to lease large format stores. And when I say large, I mean 8,000 to 10,000 square feet large. These stores will be in prime locations across major cities in India, which is exactly Decathlon's model. And this is potentially very scary for Decathlon because an unspoken rule about doing business in India is that if Reliance decides to enter into your territory, you should be really scared. But why is Reliance interested in this space in the first place? Well, the Indian athleisure and sportswear market has been growing massively in the recent years. To give you a reference, leading sportswear brands in India saw their sales grow by 35 to 60% since 2021, and that is massive. I'll give you some more numbers to show just how big this market opportunity is. First, as of 2023, the Indian athleisure market was worth $7 billion. Second, this market is expected to grow at 14% per annum till the year 2028. Third, the premium and mid-price sportswear market alone is expected to reach $8 billion by 2032. This market, by the way, will be Reliance's prime target. But now you may be wondering, why is there suddenly so much interest and growth in this market? Well, there are a few reasons. First, people are becoming more and more health conscious, especially after the COVID pandemic. Second, as we discussed in the previous episode, disposable incomes are increasing in India, especially amongst those people who already earn well. This means more people can afford branded sportswear going forward. Third, good supply chain in e-commerce has made these products very easily available even in the smallest cities of India. And finally, fourth, celebrities have made athleisure a very fashionable category. People increasingly aspire to wear the best clothes nowadays. Now see, Reliance isn't quite new to the retail game. They've already got a very strong presence across various consumer segments in India. Their presence varies from electronics to grocery to everything else you can think about. In fact, just yesterday we had spoken about how they are helping Shein come back to India, and this new Decathlon competition will only make them even stronger. Interestingly though, Reliance hasn't officially announced this new venture yet. What we know though, based on an article by Times of India, is that they have already started to look for store spaces. Now see, even with all the capital and distribution muscle, this category cannot be a cakewalk for Reliance. They have some really big giants to beat here. To begin with, global giants like Adidas, Puma, Nike, etc. are already very well established in India and have become extremely aspirational. Also, homegrown brands like HRX and Wrong have also become really popular in the semi-premium category. And of course, then there is Decathlon. By no means they will be an easy competition to defeat for Reliance. To give you some context, Decathlon's 2023 revenue was 4,000 crore rupees, which has doubled since 2021. But that said, Reliance also has some superpowers that nobody else does. First, they know how to create brands that connect deeply with Indian consumers. They've done this many times over the past years. Second, they have a massive distribution muscle and a stable supply chain. This can help them stay on top of fashion trends and also optimize their inventory to maximize profits. And finally, of course, they have the power of the massive Reliance brand name. So well, unless you're Decathlon or you run an athleisure company, it'll be really interesting to track how this market changes once Reliance dips its big toes in it. Now let's move on to the next story. Let's talk about some new drama that unfolded with Yes Bank today. Here is what happened. Mint published a story claiming that the RBI approved a sale of 51% stake in Yes Bank. But Yes Bank quickly jumped it and called it speculative nonsense. Now you might be wondering, what is the big deal in this? So to understand this, let me give you a quick backstory of Yes Bank. See, once upon a time, Yes Bank was seen as the next HDFC Bank, but things went south for them. In March 2020, the RBI had to step in. They removed the management and took control of the bank. Why, you may ask? That is because, as per RBI, years of mismanagement had left the bank in a terrible shape. As part of a rescue plan, bonds worth 8,000 plus crore rupees were written off, and a group of 10 investors, which were led by State Bank of India, pumped 10,000 crore rupees into the bank. Now, following all of this, Yes Bank's share price, which used to be at 400 rupees at one point in time, fell down to just 5 rupees. Now, after this reconstruction, SBI became a majority stakeholder with a 30% stake. Other players like ICICI and LIC held single-digit stakes, and all of these shares were locked in for 3 years. Now, once the lock-in period ended, SBI and other players sold small stakes, but they still continued to hold a bulk of their investments in the bank. Now, with the history out of the way, let's get back to today's drama. The Mint story claimed that the RBI was okay with some promoters holding a 51% stake in the bank. But here is the catch: promoters aren't really allowed to hold more than 26%. Yes Bank quickly came and denied any truth in this story. And as of May, SBI, with about a 24% stake, was still the largest shareholder in Yes Bank. Now, talking about some drama, let's move on to another story that has been brewing for almost a decade now: NSE's IPO. See, did you know NSE has been trying to go public for the last 8 years now, but somehow they just can't seem to get it done? For those who might not know, the first formal step in going public is filing a DRHP, or a draft red herring prospectus. Think of it as a 500-600 page book that tells you everything you need to know about a particular company. NSE filed its DRHP way back in 2016, but here is where things get interesting. In 2015, a whistleblower dropped a bombshell. They alleged that NSE was giving some traders an unfair advantage by letting them place orders faster than the others. Now, as you can imagine, this caught SEBI's attention pretty quickly. What was happening, you must be wondering? See, NSE had multiple servers for sending information and receiving orders. Some servers were better than the others, and some were used less. This means different servers worked at different speeds. Now, for regular traders, a few microseconds of difference would not really matter too much. But for algorithmic traders, those microseconds could mean everything. You could be 100 times as fast as your rivals, and you could place multiple orders before your rivals even knew what the market price was. Some sneaky algorithmic traders figured this hack out. They were already co-located, which means their servers were in the NSE itself. But they also took it a step further. They allegedly got NSE officials to always connect them to the fastest servers. This gave them an illegal advantage, and their profits obviously skyrocketed. Now, when SEBI found out, they were obviously not happy, because more than 1/3 of NSE's revenue comes from these co-located servers. If this money was tainted by fraud, how could they let the public buy pieces of the exchange? Now, fast forward to 2019, the SEBI started handing out punishments. The NSE was ordered to pay 6.25 billion rupees plus 10% interest. They were also banned from primary capital markets for 6 months. Also, SEBI told NSE to put their IPO plans on hold till the matter was resolved. And just like that, NSE's IPO dreams were crushed. But here is where things get interesting once again. In May this year, a non-profit called People Activism Forum went to Delhi High Court. They argued that SEBI's 6-month ban could not keep NSE from going public forever. Now, NSE has asked SEBI to take a fresh view on its IPO. Interestingly, Indian law does not specifically prevent a company with pending cases from going public. SEBI's rules just require the company to disclose the details of such cases. So what happens next, you might be wondering? Well, the ball is in SEBI's court now. If the NSE does manage to go IPO, however, it could be massive. We are talking about the world's 8th largest stock exchange. No other exchange in the world trades more derivative contracts than NSE does. Companies worth a total of $5 trillion trade on NSE. Now, back in 2016, NSE planned to raise 10,000 crores in the IPO. Who knows, this year their aim might be even higher. Well, that's all the news I have for you today. I hope you found value in this. I'll see you in the next episode tomorrow. Take care and have a nice day.